Hi everyone, welcome back for another QBO tips. Last week we shed some light on the estimates and invoices makeover that's currently rolling out. This week we're moving on from getting paid and to tracking inventory. Knowing your cost of goods sold is essential. If you don't know, your margins can take a hit. And then you're wondering, why is the bottom line so bad? And if things really slide, you could end up losing money on every sale. I mean, look at lumber. Everyone in construction had to update their prices to maintain profitability. Okay, that's a bit of an extreme case, but still. Although inventory is a simple concept, the tracking and recording can be a bit tedious, if not a bit complex. This is especially true in QuickBooks Online, which was not initially designed with inventory in mind, though there have been massive updates over the years. Let's take a look at my biggest do's and don'ts when dealing with inventory in QBO. Okay, to start, the inventory is part of the products and services page, which is grouped with the sales section here at the end. They were more commonly called items in QuickBooks Desktop. So if you hear me say that, I'm really talking about products and services in QBO. Old habits do die hard. From here, you can filter, edit the columns that are displaying, and just generally manage all of your products and services, which include inventory items. If you want something a little bit more in depth, drop it in the comments and I'll get something created for you guys. Now, don't number one, do not put anything directly against your inventory account. What I mean by this is if you're doing a new transaction and you're purchasing inventory, be it expense, check, bill, whatever, I'm just gonna use expense because it's easy. Do not use the category details, use the item details. This is where you can put your inventory item and it will track accordingly. How many did you buy? How much did you buy them for? Etc. I see a lot of people categorizing things up here directly to inventory asset, just saying I bought 6 of these in the description and the amount. Don't do this. You're better off putting these things to supplies or cost of goods sold if you're not actually tracking these items as inventory items. And this is because if you do that, and let's say I put $100 to inventory asset here, what's going to happen is your balance sheet and your inventory valuation summary aren't going to match. So if I pop over here and I update my inventory valuation summary, 596, and if I update now my balance sheet, 696. So we're in the same system, but you've thrown it off. So tip number one, if you're tracking inventory, use the item details here. Don't post it under the category directly. Use your product and service in order to purchase and sell your inventory items. For don't number two, or I guess do number one, depending on how you want to look at it, when creating an inventory item, don't change the inventory account. I guess rather be consistent with your inventory account. So what do I mean here? Well, when you set up an item, you give it an asset account. Usually your inventory asset account. This one's Rock Inventory Asset Account. So be consistent with this. If you've already posted things to this account, this inventory account, don't go back into this asset later and change which inventory account that it's going to go to. This is because it will cause problems in reporting. If I added it to just inventory asset and later changed it to Rock Inventory, I may have some value in the inventory asset, and when I sell it, it's going to come out of the Rock inventory. Overall, you're going to probably roll to be the same, but you might see something on your balance sheet where you have an overstated inventory asset and an understated rock inventory. And depending on your inventory levels, you could even be showing a negative inventory amount on your balance sheet, which just looks wrong. All right, don't number 3. Don't post adjustments to inventory accounts or opening balance equity. First off, opening balance equity should always be 0. And while there are certain situations where using it as a clearing account is okay, in general, the balance should always be 0. If I go out to my balance sheet account here in Craig's Design, we can see some incorrectly posted inventory transactions to opening balance equity. Those are wrong. And if we post an adjustment to another inventory asset account, that can throw off our inventory valuation report. Let's just say that we had this accent rock, and this is looking what happened here, and we made an adjustment, and instead of posting it against a cost of goods sold or some other P&L adjustment account, we put it against inventory asset. Well, when it comes back, we have a quantity of 0 but a value of $150, and that just should tell everybody red flags going off. Looks like I need to change my dates. So here's my adjustment. You see it shows 2 places because all it's doing is moving the value of that one from one asset account to the other asset account, so it retains its value on the inventory valuation report. And just coming in here and changing it doesn't fix the problem. You need to delete and re-enter those. So for what it's worth, the logic here when you go new and do an inventory quantity adjustment is to use an inventory shrinkage account or some adjustment account, because if you're adjusting it, that means it either is no good anymore, so you need to get it through the cost of goods sold through the P&L, or you bought it at some point and it wasn't entered against inventory, which means you overexpensed before and you're adjusting for it now. So this one can cause lots of problems, and it can compound, and it's terrible if you are using a lot of inventory. So don't post inventory adjustments to opening balance equity or another asset account. Use something on the P&L, some adjustment account. I typically use something like inventory shrinkage under a cost of goods sold. Do number 4. Do, as best that you can, try to receive the item before you bill it out. This is typically through an expense or bill type transaction where you purchase the item before you go ahead and invoice it out and make the sale. You want to do this so you're not running any negative quantity for the inventory items on hand. And you don't want to confuse some of the QBO logic when trying to compute the cost of goods sold when you have a negative quantity on hand that you're selling. Do number 5. Do be mindful of fractions of cents. If we put number 3 and number 4 together, we can get into a situation like we have with pawn lights here, where we have nothing on hand, but we have this penny hanging out. So it's not a huge deal in the grand scheme of things as far as valuing it, but it can compound, and if you're looking to fix it, it can be a pain to fix. So let's go in here and change my dates. So you can see we have the rate is at fractions of cents because we have odd numbers, doesn't devise right? So we have that, and then we have some mismatch timing between the expenses purchasing the item and selling the item. So to fix this, we'd have to go back into each one of these individually and make them an even amount. So only 2 decimal places. And there's 2 ways you can do this. You can come in here and you can do the rounding here and just say it's going to be 533, but then we're off, and then post it to the inventory shrinkage account. Or you can do the math and enter it twice, essentially. So you'd have pond lights at one rate, and then pond lights, maybe a couple others, at a rate that's a penny different. But at least the logic in QBO is going to calculate it correctly, and you're going to get rid of this fraction of a cent rounding issue. Finally, do number 6. Do be mindful of the costs when you are doing an adjustment. It's easy to think that I'm just going to do new inventory quantity adjustment and everything's going to be peachy. But if there's no history for that transaction, it's a brand new item, hasn't been used before, it's going to adjust at the standard cost rate that you put, and that may not be the cost that you actually purchased it for the first time you bought it. Similarly, if there is history and you do a quantity adjustment, it's going to use that last rate that you bought it at. So if it was 175, it would use that number. So if the last purchase price isn't the actual adjustment amount that you need to be accurate, this is going to pose a problem, and just simply using an inventory adjustment won't get you where you want to go. Your inventory adjustment is going to be off. So what you can do here is do what I call a manual adjustment. So if you just make a new, I usually just use an expense item here. You can do an accent rack for $175. So I'm receiving this into inventory for $175, but I didn't pay $175. I'm just trying to move it from somewhere because it's an adjustment to get my inventory correct. So here you can do your inventory shrinkage or whatever adjustment count you're using and use a negative amount to balance that out. So my expense amount is 0, so I'm posting a 0 transaction. And what this allows you to do is control the amount of that adjustment to be exactly what you want it to be. So do be mindful of the costs when you're making these adjustments so that the adjustment for your inventory is correct. Well, I know that was a lot, but inventory can be like that. There's so many little things that go into it. And thinking about the inventory costs, the cost of goods sold, reporting, all those things are a must in order to keep things in line. Otherwise, you can really combine and compound the issues that you're going to see. And yes, in the course of dealing with clients in the real world, I have seen many of these issues, especially the valuation report not matching the balance sheet. If you have comments or questions or a tip that I didn't mention, please feel free to post it. I hope this helps you guys out. Thanks so much for watching.